Today's markets are more disconnected from fundamentals, with mega IPOs like SpaceX, stocks like SanDisk soaring, and .com stocks like Intel surpassing their old all-time highs. We are seeing the same scary patterns that led to the 2000 .com crash. As a value investor, staying disciplined with fundamentals, value, and margin of safety is crucial to navigate the current noise of hyped IPOs and tech stocks. Scary memories of the 2000 .com crash pop up as major stocks unleash a mania like the SanDisk spike. When looking at charts of Intel, Cisco, Corning, and NetApp, we see a massive parallel pattern. All these stocks lost heavily during the crash starting in 2000, ranging from negative 82% for Intel down to unbelievable negative 99% for Corning. Fast forward to today, and all four stocks are experiencing the exact same hype prior to the year 2000. So since the rock bottom of the .com crash, Intel has six-folded, surpassing its .com high on April 23 this year, jumping another 32% from this point. Cisco has tenfolded, surpassing its .com high on December 10, 2025, jumping another 79%. NetApp has 16-folded, surpassing its .com high on May 27, jumping another 17% from that point on. And Corning, the fiber and glass specialist, has 103-folded, surpassing its .com high on February 5 this year, jumping yet another 509%. While in parallel, the whole semiconductor and memory sector is skyrocketing with stocks like Micron, Western Digital, and SanDisk. The latter not doubling or tripling, instead SanDisk 44-folded in just a single year. All these semiconductor companies are boosted by investors because of the increased capital expenditure from prominent names such as Amazon, Microsoft, Alphabet, Meta, and Oracle, which combined will spend $775 billion while having an operating cash flow of just $757 billion. Alphabet also announced on June 2nd that it will raise $80 billion through equity sales to fund its 2026 and 2027 capex. Just 2 days later, Google upsized the deal to $84.75 billion. Jason Helfstein from Oppenheimer commented, "The fact that Alphabet chose equity versus credit suggests the market has become less favorable to AI data center financing." Now, the bottom line is not to panic. Instead, keep an eye on why this matters and learn what these reactions imply. As Jason Zweig, a legendary Wall Street journalist, pointed out in Chapter 20 of Benjamin Graham's The Intelligent Investor. Imagine you invested in Amazon on December 10, 1999, when the stock hit its all-time high back then. During that time, Amazon was losing millions of dollars a day. However, this did not prevent the stock from rising 970% in 1998, and yet another 99% in 1999. Since Amazon's earnings were negative, you could not use a price-to-earnings ratio to estimate how expensive the stock was. Comparing its price-to-sales ratio of 15 with Walmart's 1.5, the world's largest retailer, gives you a good feeling on yes, Amazon was pretty expensive back then. Convinced that Amazon will become one of the hyper-growth stocks, you would have been completely right. But because it had no margin of safety, you would have to wait 10 years and survive a 94% loss along the way to make even a modest profit at the very end. Waiting until September 28, 2001 and investing in Amazon when it hit rock bottom, you would have bought Amazon at a price-to-sales ratio of 0.74, which was half of Walmart, even though Amazon was growing faster than Walmart back then, resulting in an astonishing 35-fold over the next 10 years. Additionally, today's markets show a scary similar pattern when it comes to IPOs like SpaceX. The company's S-1 filings reveal a total loss per share of $1.69. Yet the stock will have a price-to-sales ratio of around 93 when it starts trading on June 15. SpaceX is a conglomerate of three separate companies: Starlink, the satellite internet business, the space and rocket business, and xAI, the competitor to OpenAI and Anthropic. Only Starlink is making money with $4.4 billion in operating earnings, while the space business had an operational loss of $0.657 billion, and xAI burned $6.4 billion. This resulted in an operational loss of $2.6 billion. Adding interest and taxes, SpaceX lost $4.9 billion. Considering that SpaceX target valuation sits at $1.75 trillion, it is said to be worth 1.75 times Walmart, which is worth $950 billion. Or to put it differently, SpaceX will be worth more than Coca-Cola, McDonald's, Costco, Procter & Gamble, Colgate-Palmolive, and Pepsi combined. All these companies together had a net income of $56.8 billion, which makes SpaceX IPO target price even worse. That's why many investors generally say IPO stands for "it's probably overpriced." The parallel patterns to Amazon's IPO during the 1990s are scary, yet helpful to stay focused on fundamentals of a stock. While everyone's hyped about SpaceX, OpenAI's, or Anthropic's IPOs, we as value investors should stay humble yet calm and think outside of the box instead of going with the crowd. Therefore, we identified a selection of 10 fairly or undervalued boring stocks, many of them paying dividends for decades and trading under a PE ratio of 22. All stocks are within the S&P 500, which could be a reasonable counterbalance to our core ETFs of the S&P 500 or world ETFs, consisting mainly of large tech stocks. While more US households drive older cars for longer, AutoZone will profit from that trend by being the largest US retailer and distributor for spare parts, trading only at a PE ratio of 21.4. Next up is Royal Caribbean Cruises paying 1.26% dividends and trading at their 20-year median PE ratio of 17. While everyone is talking about SpaceX, Northrop Grumman has also a space division, besides its business with military equipment, and is trading at a PE ratio of 17, which is just 7% above its 20-year median of 15.9, while paying 1.71% in dividends. Otis, the elevator and escalator producer, which was spun off in 2020 from United Technologies, is super boring but pays a solid 2.43% dividend and is trading at just 18.7, which is super low compared to its competitors, Kone and Schindler, both trading at 27. Adobe paying no dividends, though trading at a super low PE ratio of 14.7 compared to its 20-year median of 45. Tractor Supply, which sells not only garden equipment but also everything for your beloved pets, pays a nice 3.15% dividend and trades at just 14.7, way below its 20-year median of 23.7. And our last 4 stocks are all in the golden club of dividend kings, meaning all of them are increasing their dividends for more than 50 consecutive years. Cisco, the largest US food service distributor, paying a solid 2.81% dividend and trading at a PE ratio of just 21. Procter & Gamble paying a sweet 3% in dividends for a PE ratio of just 21.4. Or take a look at Target paying 3.7% dividends for a PE ratio of just 16.2. And lastly, Kimberly-Clark, which pays a hefty 5.09% in dividends while trading at a PE ratio of 19.2. By the way, all these bargains combined have a market cap of just $1.1 trillion and a median PE ratio of 17.2. So as value investors, we can definitely find bargains despite all the hype stocks if we focus on fundamentals, read into SEC filings, stay disciplined, and keep investing long term. When this video motivated or helped you, please make sure you subscribe. Thanks for watching and see you in the next video.